All right, welcome to this explainer. Today, we're taking a look at a concept that's, well, highly technical but absolutely crucial to get right. We're talking about the reconstitution of a partnership, and specifically, we're zeroing in on the methods of valuation of goodwill. Now, if you're already involved in a business partnership, you know the drill. Things change, partners leave, new ones come on board, profit-sharing ratios get tweaked, and when that reconstitution happens, you have to value the business. But how do you value the invisible parts of a business? That's exactly the puzzle we're going to solve today. It really all boils down to this one core question. How on earth do you price a business's reputation? Think about it like this. Say you and a partner have spent the last 10 years building just a wildly successful bakery. You didn't just buy ovens and flour, right? You built a loyal customer base, a brand name people recognize, and real neighborhood trust. That invisible magic, that is your goodwill. So when it's time to restructure your partnership, you have to put a fair, concrete price tag on that invisible asset. You can't just throw out a guess. You need math. You need standardized accounting.
Okay, let's dive into this. Our main goal today is pretty straightforward. By the end of this explainer, you're going to be able to explain the 3 specific methods for calculating goodwill. We're going to completely take the guesswork out of pricing a business's reputation and give you the exact roadmap that professionals use to settle these partnership valuations. Here is our quick roadmap for today. First, valuing business goodwill. Then, the average profit method. Next, adjusting abnormal items. After that, the super profit method. And finally, the capitalization method. Kicking things off with Section 1, valuing business goodwill, and the 3 standardized methods. So, why do we actually need these standard methods? Well, without a solid, objective framework, partners would just endlessly argue over what a brand's reputation is actually worth. It would be chaos. So, whenever a partnership is reconstituted, accountants turn to one of these 3 distinct solutions: the average profit method, the super profit method, or the capitalization method. Now, each one takes a slightly different philosophical approach to what makes a business valuable, but here's the key. They all rely on hard data from the company's past performance. Moving right along to Section 2, the average profit method, where we find the baseline. Let's put ourselves in the shoes of a partner, starting with the most fundamental approach.
The logic behind this one is actually pretty straightforward. If a business made money in the past, it's a safe bet it'll make money in the future. But we can't just take the raw bottom line at face value. Step 1 actually requires us to calculate the normal past business profits for each year. Normal is absolutely the key word here. We have to make adjustments to strip out those weird one-off events, both the unusually good and the unusually bad ones, just to find the true everyday profit-generating power of the business. Once we've found that true normal for each year, Step 2 is simply adding those adjusted profits together.
Which brings us to Section 3, adjusting abnormal items and refining the profit. Now, you're probably wondering what exactly needs to be adjusted in that first step to find this normal we keep talking about.
Now, what's really interesting about this is how we have to essentially balance the scales to neutralize past anomalies. To find that normal profit, you actually have to add back your abnormal losses and deduct your abnormal gains. I know it sounds totally counterintuitive at first, right? Like, why would you add a loss? Well, think about it. If your warehouse flooded last year, that's an abnormal loss. It made your profit look artificially low for that year. To see your true normal business performance, you have to pretend that didn't happen and add that lost money back into your calculation. And conversely, you've got to deduct abnormal gains because a lucky one-time windfall makes your baseline look artificially high. Let's look a bit closer at the ledgers. To isolate our repeatable profit, you've got to add back those abnormal losses. Things like an undervalued stock, a random non-recurring expense, or, heaven forbid, a freak fire. On the flip side, we must deduct abnormal gains, like a lucky profit on an asset sale or some random non-recurring income, just to prevent artificially inflating our baseline. By systematically adding and deducting these specific items, we strip away all the noise and isolate the true, repeatable profit of the partnership.
Okay, so once we've refined those profits for each year and tally them up, the math is a breeze. Step 3 is just calculating the average profit by taking those total adjusted profits and dividing them by the number of years. Simple enough. Finally, Step 4 is the actual valuation. Your goodwill equals your average profit multiplied by the number of years purchased. Now, the number of years purchased is essentially just an agreed-upon multiplier. It represents how many years the new partners expect to enjoy these established average profits, all thanks to the brand's past efforts.
Let's move to and see how this builds in Section 4, the super profit method, beyond the normal. Because, let's be real, sometimes being average just doesn't capture a company's true value. Before we can figure out what makes a profit super, we need to knock out some vital jargon. What exactly is a normal profit for your specific industry? Our source defines normal profit as the capital employed multiplied by the normal rate of return. Basically, if you invest a certain amount of capital into a standard, run-of-the-mill business in your industry, there is an expected average percentage of return you should be getting. That baseline expectation, that is your normal profit.
So how do we actually put this to work for valuation? It's a logical four-step climb. Step 1. Calculate your actual average profit, exactly like we did in the previous method. Step 2. Calculate the normal profit expected for your industry based on your invested capital. Now, step 3 is where the magic happens. You calculate the super profit by taking your actual average profit and subtracting that normal profit. Think of it this way. If your business pulls in $100,000, but the standard for your industry size is only $60,000, well, that extra $40,000, that is your super profit. It's the literal premium you earn because of your exceptional reputation and customer loyalty. Finally, in step 4, you value the goodwill by multiplying that super profit by the number of years purchase.
And finally, Section 5, the capitalization method, formula focus. This is our third standard method, and fair warning, it's the most formula-intensive strategy of the bunch.
Now, what's really unique about this method is that it actually splits off into two separate pathways to calculate the exact same invisible asset. You can either perform a capitalization of the average profit or a capitalization of the super profit. Both approaches are going to get you to your goodwill valuation, but they take very different mathematical routes to get there.
So the crucial point here is that the logic actually works in reverse. For the capitalization of average profit, goodwill equals your average profit multiplied by 100 divided by the normal rate of return. That first chunk of the equation tells you the total capital value your business should theoretically have in order to generate your current average profits. Then, you take that massive capitalized value and you subtract your actual capital employed, meaning the physical money and assets you actually have sitting in the business. The difference between the massive capital your profits imply you have and the physical capital you actually have, that difference, right there, is your invisible asset. That's your goodwill.
Now, the capitalization of super profit, it is elegantly simple by comparison. Because super profit already accounts for those extra above-average earnings of your business, you can skip subtracting the capital employed. You literally just directly capitalize the extra profit you're making using the industry's normal rate of return, and boom, you have the total value of your goodwill.
Wow, okay, we've covered a ton of ground today, looking at the average profit, the super profit, and the capitalization methods. But it leaves us with a pretty fascinating real-world puzzle. If you were sitting across the negotiating table right now during the reconstitution of a partnership, which method provides the most accurate reflection of a company's true intangible value? Does a steady, reliable average profit tell the whole story, or does capitalizing a super profit truly capture the magic of a brand's reputation? The math gives us the tools for sure, but choosing the right method, that's the true art of business. Thanks for joining me on this explainer, and keep learning.